If you own zero hard assets right now, you are making a bigger bet than you think. Most people think they are playing defense when they sit in cash, bonds, retirement funds, and big stock indexes. I do not see defense there. I see layer after layer of paper promises inside a system already stretched by debt, politics, and money creation. And over the next 18 months, that stretch could stop feeling like a theory and start feeling like pain. If you want to stay close to the patterns I watch before they become headlines, keep this channel near you, because I am about to walk through the part of the cycle most people only notice after the damage is done. I have spent my life studying how money, debt, and power move together. What I have learned is simple. People usually worry about the wrong thing too late. They watch prices while the real shift happens under the plumbing. The first mistake is that most people hear the words hard assets and think I am talking about some dramatic survival trade. I am not. I am talking about owning at least some things that do not depend on another person, bank, company, or government keeping a promise. Gold is the clearest example. Some land, some commodities, and some real assets can also help if they are owned the right way. When I look at a normal portfolio today, I see something many investors do not. I see concentration. Cash is a promise. Bonds are promises. Many stocks, especially at high prices, are claims on future promises. When all your wealth lives inside promises, you are not diversified in the way that matters most during a debt squeeze. A lot of people think the issue is just inflation. That is too shallow. Inflation is part of the story, but it is not the engine. The engine is the debt cycle. When debts get too large relative to incomes, the system cannot handle them cleanly, and someone has to absorb the loss. That loss can show up in a few ways. You can get defaults, you can get austerity, that means cuts and pain. You can get transfers from one group to another through taxes or policy, or most often you get devaluation. That means the money gets worth less, even if the number on your account looks the same. This is why I say the next 18 months matter. We are moving through a period where governments still need to borrow heavily, private markets still need confidence, and central banks have less room to rescue everything without side effects. If growth slows, they will want easier money. If inflation stays sticky, they cannot ease too much. If bond buyers get nervous, the pressure rises fast. So I want you to ask yourself something uncomfortable. If every dollar you own depends on paper claims, where exactly is your protection when the value of those claims is weakened from the top down? That is not a trick question. It is the question most people avoid because the answer forces a change. And markets punish people who delay obvious changes for emotional reasons. Let me make the math real. The U.S. federal deficit was about $1.8 trillion in fiscal 2025. Debt held by the public rose to about 99.8% of GDP. GDP is the total value of what the economy produces, and interest costs move toward the $1 trillion a year area. That means an enormous amount of new borrowing is now going toward paying for old borrowing. When a debtor has to borrow more just to service debt, the quality of that debt changes. It may still get paid, but the way it gets paid matters. A country like the United States is unlikely to say, we refuse to pay. The more common path is to pay in money that buys less. That is a softer form of default, but for savers, it still hurts. This is where many people get trapped by appearances. They think, my bond did not default, my bank account still has the same number, my index fund is still invested, but purchasing power is what matters. Purchasing power means what your money can actually buy in the real world. If your money buys less food, less housing, less energy, and less security, you lost wealth, even if your statement looks calm. I often picture the average careful saver when I think about this. I picture someone who did not gamble, someone who worked, saved, bought index funds, kept cash, maybe added some bonds, and assumed caution would be enough. Then the rules of the game change quietly. Suddenly, being cautious inside the wrong system becomes its own form of risk. This is why zero hard assets is not neutral. It is a position. It is a vote of full confidence in the stability of debt money, financial assets, and policymakers. I do not make that vote with all of my wealth. I never have. History taught me that systems look strongest right before people rediscover what cannot be printed. If this way of thinking is making you recheck your own portfolio in your head, stay with me. That discomfort is useful. Would you rather feel it now in a quiet room or later when the market is making the decision for you? Most financial mistakes are not math mistakes. They are timing mistakes caused by denial. Now let me show you why I focus so much on gold even when I talk about hard assets more broadly. Gold is not valuable to me because it shines. It is valuable because it is no one else's liability. A liability is something someone owes. Gold does not need a bank to honor it, a board to protect it, or a politician to rescue it. That is different from bonds. A bond is a promise to pay you later. That works well until there is too much debt in the system. Then governments and central banks face a choice. They can allow painful defaults and deflation, which means falling prices and falling activity, or they can support the system with easier money. Most choose easier money. And once that happens, hard assets begin to matter in a different way. They stop being a side bet. They become a reference point for what money is losing. That is why I have long said gold is more like money than most people realize. Cash can be printed. Gold cannot. That one difference becomes very important late in debt cycles. People sometimes tell me gold does not yield anything. That is true. But I always ask the next question, yield after what? If inflation is high, taxes take a cut, and the currency is being weakened, a nominal yield can still leave you poorer. Nominal means the number on paper, not the real buying power in your life. And I do not think the institutional behavior around this is random. In 2024, central banks added about 1,045 tons of gold. That was the third straight year above 1,000 tons. It was also far above the roughly 473-ton annual average from 2010 through 2021. Big institutions do not move like that by accident. Look at who was buying. Poland added about 90 tons. Turkey added about 75. India added about 73. China reported around 44. These are not emotional retail trades made after a scary headline. These are reserved decisions. That matters because central banks sit closer to the core of the monetary system than the public does. They see settlement risk, they see sanctions risk, they see reserve risk, they see what happens when trust between countries breaks down. And when they choose more gold while the public chooses more paper claims, I pay attention. So here's another question I would seriously sit with. If central banks are buying hard money while everyday investors are being told paper diversification is enough, which side of that trade sounds more patient to you? I am not saying copy every central bank. I am saying learn from their behavior. Actions taken by large informed players often reveal what polite public language tries to hide. There is another layer that almost nobody talks about clearly. A huge share of recent stock market gains has come from a narrow group of companies. At one point, the AI-driven giants accounted for around 80% of the gains in US stocks. The top 10% of income earners own about 85% of stocks and account for roughly half of consumer spending. So when stock prices rise, the economy feels stronger than it may really be. That wealth effect works in reverse too. If a narrow leadership group stumbles, the damage can spread far beyond traders. Spending slows, confidence fades, credit gets tighter, and policymakers come under even more pressure to support markets, which can mean more debt, more easing, or more quiet currency damage. Again, hard assets matter most when the system starts solving one problem by creating another. Now I can hear the skeptic already. What if inflation keeps cooling? What if the economy avoids recession? What if stocks keep rising and hard assets lag? That is fair. I always try to take the other side seriously because markets punish certainty more than ignorance. My answer is that owning some hard assets is not a prediction that the world ends. It is recognition that the range of possible outcomes is wider than most portfolios admit. If inflation cools but stays above target, hard assets can still help. If growth slows and money gets easier, hard assets can still help. If trust in debt assets fades, hard assets can help the most right when you need them. This is the part people miss. They think a hedge has to win every month to be useful. That is not how protection works. You buy insurance hoping you do not need it. And when you do need it, you do not ask why it underperformed in a calm quarter. You ask whether it is there when stress arrives. The global picture makes this even more important. Worldwide debt has stayed above 235% of global GDP. That is not a small imbalance. That is a world carrying claims that are huge relative to what the world produces. When debt gets that large, politics and money cannot be separated anymore. And politics right now is not calm. We are dealing with trade tension, war risk, sanctions, bloc formation, and deeper mistrust between major powers. In that kind of world, reserve assets matter. Neutral assets matter. Settlement without dependence matters. This is one reason gold has moved back toward the center of the global conversation. History is very clear with me on this. When I study the 1970s, I do not just see inflation. I see a shift in the monetary order, fiscal stress, oil shocks, and a loss of confidence in old assumptions. People who held only financial claims learned a hard lesson. People who held some hard money and real assets had a very different experience. The lesson was not that hard assets always win. The lesson was that paper confidence is cyclical. I also look much further back. Since 1750, about 80% of currencies have disappeared, and the survivors were heavily devalued over time. That does not mean every currency vanishes tomorrow. It means betting on endless stability is not the conservative move people think it is. History does not reward blind trust in printed money. It rewards balance, flexibility, and respect for cycles. If you are finding value in how I connect these pieces, keep following along here. I do not come to this with a need to entertain you. I come to it with a need to be honest about what the system is signaling. And honest signals are usually worth more than confident slogans. That is especially true near turning points. Now, let me deal with a common misunderstanding. When I say hard assets, I am not saying every house, every commodity stock, or every piece of real estate is safe. Some real assets are loaded with debt, some have tax risk, some depend too much on cheap financing. A hard asset owned the wrong way can still act like a fragile financial asset. That is why I separate real from leveraged. If you own a property with heavy debt, rising costs, weak cash flow, and policy risk, that is not the same as owning something resilient. If you own a commodity company with bad management and too much borrowing, that is not the same as owning the commodity. Structure matters. The thing itself matters, but so does how you hold it. Gold has a special role because it is the cleanest form of diversification against debt money. It does not solve every problem. It does not produce cash flow, but it does something paper assets cannot do. It stands outside the promise chain. Late in the cycle, that matters more than most people expect. So what could happen next? I see at least three broad paths over the next 18 months. The first is a soft landing that is softer in the headlines than in real life. Growth slows but does not crack. Inflation cools, then sticks above comfort, and real returns on cash and bonds stay thinner than people hoped. In that world, people feel less panic than they should. They think the crisis was avoided, but their money slowly loses quality. Asset prices may stay elevated, but real wealth does not improve the way the headlines suggest. Hard assets do not need chaos to matter. They just need money to keep losing credibility at the margin. The second path is a sharper slowdown or recession. Then policymakers cut rates, support liquidity, and try to cushion the fall. Liquidity means making sure money and credit keep moving. That may help markets for a time. But easier money used against a debt problem often pushes people back toward scarce assets. The third path is the one investors least want to imagine. Bond markets begin to demand more compensation for lending to governments running large deficits. That means yields rise even when growth is not strong. Then policymakers face a nasty trade-off. They can tolerate tighter conditions and pain or step in and weaken the currency response. Neither path is friendly to someone holding only paper claims. Here is what ties those scenarios together. In all three, zero hard assets leaves you exposed. In the soft landing, you risk slow devaluation. In the recession, you risk policy-driven money weakening. In the bond stress case, you risk both financial volatility and a loss of trust in debt assets. Different roads, same vulnerability. That is why I do not tell people to panic. Panic is expensive, but I also do not tell them to wait for perfect clarity. Perfect clarity usually shows up after the repricing. The time to build resilience is when it still feels optional. Once it feels urgent, prices and emotions both get worse. And no, I am not saying put everything into gold. I have never believed in one-way bets. I believe in good diversification. For many investors, I have said a gold allocation in the 10% to 15% area can make sense as part of a broader portfolio. Not because gold is magic, but because zero is usually a mistake. If you are starting from zero, I would not get cute with timing. Trying to buy the exact dip is how people stay unprotected while telling themselves they are being smart. I would rather own part of what I know I need than hold nothing while waiting for a cleaner entry. If I wanted to move toward a target allocation, I would do some now and average the rest over the next few months. The bigger risk is often not being in the position you know you should have. Ask yourself this with total honesty. If the next 18 months bring even a mild version of the pressures I am talking about, will your current portfolio behave like a shield or like a paper stack in a storm? That is the question. Not whether your favorite asset wins for 6 weeks. Not whether the headline CPI number looks nicer next month. What matters is whether your wealth can hold its ground when the system starts protecting itself at your expense. I have watched this pattern repeat in many forms. People crowd into whatever worked in the recent past. They call it prudent because everyone around them agrees. Then conditions change, and they learn too late that consensus is not the same as safety. The biggest losses often come from assets that looked the most normal right before the regime changed. And that is what I believe many people are missing now. They are treating an unstable system like a permanent one. They are treating paper wealth like settled wealth. They are treating market calm like structural health. Those are not the same thing, and the gap between them is where future pain hides. I am calm about this, but I am not casual. I do not need a collapse story to see the need for protection. I just need to see debt, incentives, and history clearly. When governments owe too much, central banks are constrained, and institutions start reaching for neutral stores of value, I listen. That is not fear. That is pattern recognition. So if you take one thing from me, let it be this. Do not confuse a rising account balance with real safety. Do not confuse diversification across paper claims with true diversification. And do not assume the next phase will reward the same blind spots the last phase rewarded. Late cycle wealth is protected by balance, not by hope. I cannot tell you the exact month the pressure will show up. No one can. But I can tell you what the setup looks like when I have seen it before. Too much debt, too much confidence in paper assets, too little respect for what cannot be printed. That mix has humbled a lot of smart people. If you own zero hard assets, the next 18 months do not need to become a catastrophe for you to feel them. A slow grind can do enough damage. A quiet devaluation can do enough damage. A small shift in trust can do enough damage. You do not need the world to break for an unprotected portfolio to bend. That is why I would rather be early and balanced than late and certain. I would rather hold some real protection and endure a few months of underperformance than discover, under pressure, that all of my safety was built on promises. Because when the cycle turns, what looks boring suddenly looks priceless. And when money gets weaker, reality gets expensive.